This silver is selling for less than it's worth. $3 under spot, $5 under spot. Dealers are practically giving it away, and nobody is coming. Not one buyer. This isn't cheap silver. This is silver that the market is quietly rejecting. And if you understand what that means, you'll never look at your stack the same way again. Welcome back to Currency Archive, the channel where we don't guess, we document. Now, before we go any further, if you've been with us for a while, you already know what we do here. But if this is your first time, do me a favor. The way you do a favor for an old friend, just hit that subscribe button, one click. That's all I'm asking. And while you're at it, drop a comment below. Tell me where in the world you're watching from today. Because this story is playing out everywhere. And I want to know exactly where you are standing when it all unfolds. Something strange is happening in the silver market. Not the kind of strange that makes headlines. Not the kind that triggers emergency meetings on Wall Street. This is quieter than that. More unsettling than that. Dealers across the country are placing silver on their counters, priced below spot. $3 under, $5 under. In some cases, even more. They are not doing this out of generosity. They are doing this out of desperation. They have silver that they need to move. And the buyers are simply not showing up. This is the anomaly. In any functioning market, a price drop creates demand. That is the most basic rule of economics. Lower the price, and more people buy. But right now, in the physical silver market, that rule is breaking down. And when the rules of a market break down, serious people pay attention. To understand why this moment matters, one must first understand what spot price actually means. Spot price is not just a number on a screen. It is the globally agreed upon baseline value of silver at any given moment. It represents what the market, in its collective intelligence, believes 1 ounce of silver is worth right now. Everything traded above spot carries a premium. Everything traded at spot is considered fair value. Nothing is supposed to trade below it for long. When silver sells under spot, it does not mean the silver is worthless. It means something far more important. It means the seller needs liquidity more than they need fair value. It means demand has fallen so sharply that even a price below the accepted global baseline cannot attract a buyer. That is not a market correction. That is a market sending a distress signal. The silver in question is not obscure or rare. It is not some industrial byproduct or low-grade material most investors would ignore. This is alloy silver, sterling silver, 90% silver, 80% silver, 40% silver. These are categories that serious collectors and investors have traded for generations. Not long ago, these same categories commanded extraordinary premiums. 90% silver, commonly known as junk silver, was once one of the most sought-after forms of physical metal in the retail market. At its peak demand, just a few years ago, dealers were selling it at premiums that rivaled American silver eagles. In some cases, it was trading at nearly double the spot price. Buyers were aggressive. Supply was tight. The energy on dealer floors was electric. Today, that same silver sits in trays, discounted, waiting, untouched. Josh, a dealer with direct ground-level experience in the physical silver market, described the current environment in terms that were both simple and deeply revealing. His shop had a busy week, but not in the way the silver price might suggest. Foot traffic came in, conversations happened, but the conversion rate, the number of people who actually bought, told a different story. 4 items moved during a sale that offered silver at $3 to $5 below spot. 4 items. In a market where silver had been climbing steadily, where headlines were speaking of potential runs toward $100 per ounce, 4 items moved at a discount that should have cleared shelves by noon. It did not. This is where the serious analyst stops and asks a question that most retail observers never think to ask. Why? Not why is silver not selling, but why, at this specific moment in history, has a category of silver that once sold at double spot price now failed to move even at $5 below it? What changed? What shifted inside the mind of the buyer? And more importantly, what does that shift reveal about where this market is actually heading? The answer is not simple. It is not comfortable. And it is not something that paper markets, comics contracts, or financial news channels are discussing. But the physical market, the real market, the one measured in ounces held in human hands, is speaking clearly. The question is whether anyone is listening. There is a number living inside the mind of the silver buyer. It is not a rational number. It is not derived from supply chain analysis or geopolitical risk assessment or a careful study of COMEX positioning. It is a round number, a clean number, a number that has no technical significance whatsoever in the architecture of precious metals markets. $100. And right now, that single number is doing more damage to silver demand than any market crash, any Federal Reserve announcement, or any global economic event could ever do. Because the buyer who is sitting on the sidelines today is not scared of silver. They are not bearish on silver. They are simply waiting for a number. And until that number appears on their screen, they will not move. This is the psychology, and it is paralyzing the market. To understand how powerful this psychological barrier truly is, one must travel back in time, not decades, just months. In the weeks approaching January of this year, silver was pushing aggressively toward $100 per ounce. The energy in the market was unmistakable. Dealer floors were busy, phones were ringing. Customers who had never bought silver before were walking through doors asking questions. Customers who had bought silver before were coming back to buy more. The momentum was real, the excitement was real. And then, silver pulled back. It did not collapse. It did not crash in any dramatic or catastrophic sense. It simply retreated from the $100 to $110 range, back down toward $90 per ounce, a move that, in percentage terms, most serious investors would consider entirely normal within a bull market structure. But the retail buyer did not see a normal pullback. They saw a missed opportunity, and they decided to wait for the next one. Josh described this behavioral pattern with a clarity that no academic textbook could replicate. He noted something that sounds almost counterintuitive when stated plainly. Once silver reaches $100, his shop will get busier, not quieter, busier. This is the paradox that serious market observers must understand. Higher prices in the precious metals retail space historically attract more buyers, not fewer. When silver was approaching $100, people felt urgency. They felt the fear of being left behind. They felt that a threshold was being crossed. And they did not want to be the person standing on the wrong side of it when it happened. But at $90, that urgency evaporates. $90 feels like a waiting room. It feels like the market is pausing, catching its breath, giving the buyer time to think. And when a buyer has time to think, they hesitate. When they hesitate, they wait. And when they wait, dealer floors go quiet. This is not unique to silver. Behavioral economists have documented this pattern across multiple asset classes for decades. Human beings are wired to interpret rising prices as confirmation of value. When something costs more today than it did yesterday, the instinct of the average buyer is not caution. It is validation. The rising price tells them they were right to want it. The falling price, or even the stable price, tells them nothing. It creates no urgency. It triggers no action. It simply sits there. And so does the silver. But here is where the story becomes genuinely important for the serious analyst and the strategic investor. The sideline capital has not disappeared. The buyers who walked through dealer doors in January, who asked questions, who picked up the silver and felt its weight, they did not lose interest in silver. They did not redirect their money into something else. They are still there, watching, waiting. Josh confirmed this directly. Customers are still coming in. Conversations are still happening. The interest has not died. Only the action has stopped. And there's a profound difference between a market where buyers have left and a market where buyers are holding their breath. One signals the end of a cycle. The other signals something far more explosive. The question that every serious investor must now sit with is not whether silver will move. History has already answered that question many times over. The real question, the one that separates the prepared from the unprepared, is this. When the breath finally releases, when that number finally appears on the screen, will they be ready? Or will they still be waiting while the market moves without them? There's a language that markets speak. It is not written in press releases. It is not broadcast on financial news channels. It does not appear in the quarterly reports of major banks or the carefully worded statements of central bank governors. It is spoken quietly, in the spaces between the headlines, in the detail that most observers walk past without ever looking down. The alloy silver market is speaking that language right now. And what it is saying should concern every serious investor, every strategic thinker, and every business mind that understands how financial systems behave in the moments just before something significant changes. To appreciate the warning being issued, one must first understand what alloy silver has historically represented in the broader precious metals ecosystem. Alloy silver is not the premium product. It is not the American Silver Eagle with its government guarantee and its collector appeal. It is not the pristine 1-ounce round sitting in a protective case. Alloy silver, sterling silver, 90%, 80%, 40%, is the working class metal. It is the category that entered the market through everyday circulation, through old cutlery, through pre-1965 American coins that passed through millions of ordinary hands before finding their way onto dealer shelves. And because of that history, alloy silver has always functioned as a sensitive instrument, a barometer, a leading indicator of where retail sentiment in the broader silver market is truly positioned. When alloy silver moves, the market is healthy. When alloy silver stalls, something underneath the surface is shifting. Right now, alloy silver is not just stalling. It is being offered at prices the market has rarely seen, and it is still not moving. This is where the structural warning begins to take shape. Consider the disconnect that now exists in the silver market. On one side, paper silver, COMEX contracts, futures positions, electronically traded instruments that represent silver on spreadsheets, in accounts, in the digital architecture of global finance. These instruments continue to trade at elevated levels. The price they display is the price most people see when they search silver on their phones. On the other side, physical silver, real metal, ounces that exist in the physical world and must be stored, transported, and handled by actual human beings. This silver, specifically in its alloy form, is being discounted aggressively by dealers who cannot move their inventory. Two prices, two realities, one market. This is not a healthy condition. This is a fracture. And fractures in financial systems, when left unaddressed, do not heal quietly. They widen. Slowly at first, then suddenly. History has recorded this pattern before. In 1980, when silver reached nearly $50 per ounce during the Hunt Brothers episode, the disconnect between paper positioning and physical reality contributed to one of the most violent reversals the precious metals market had ever witnessed. In 2011, when silver again approached $50, the same structural tension between paper markets and physical supply chains created a price dislocation that took years to fully resolve. The current moment is not identical to either of those episodes, but the architecture of the warning, the growing gap between what paper says silver is worth and what physical buyers are actually willing to pay, carries echoes that serious students of market history cannot afford to ignore. Dealer inventory is building, quietly, without fanfare. Alloy silver that would have been absorbed by the market within hours just a few years ago is now sitting on shelves for days, then weeks. The dealers who hold this inventory are not panicking, not yet, but they are watching. And what they are watching is time. Because in the physical silver market, unsold inventory is not a statistic. It is a pressure gauge, and pressure, in any closed system, always finds a release. There is another dimension to this structural warning that demands examination. It is the behavior of institutional participants versus retail participants in the current environment. Retail buyers, as established in the previous analysis, are waiting for $100. They are psychologically anchored to a number. Their behavior is predictable, documented, and in many ways understandable. But institutional behavior tells a completely different story. While retail floors sit quiet, while alloy silver collects dust in dealer cases, larger, more sophisticated participants in the silver market are not waiting. They are not anchored to round numbers. They are not watching prices on their phones and waiting for psychological confirmation. They are positioning. Not loudly, not in ways that trigger headlines or attract attention, but in the documented movement of physical metal, in the delivery notices filed at COMEX, in the vault inventory reports that most retail observers never read. The footprints of serious capital are visible to those who know where to look, and those footprints are moving in one direction. This is the message encoded in the silence of the alloy silver market. When the working class metal goes unwanted, when dealers cut prices below the globally accepted baseline and still find no takers, the market is not simply experiencing a slow week. It is undergoing a recalibration, a sorting process, one that historically separates those who understood what was happening from those who realized it too late. The alloy market is not broken. It is a mirror. And what it is reflecting right now is a system under pressure, a retail base that is frozen, a physical market that is quietly accumulating tension, while the paper market broadcasts a number that fewer and fewer physical buyers are willing to honor. When the mirror finally shows something different, when the alloy shelves finally go empty again, it will not be because the market recovered gently, finally broke. There is a moment in every market cycle that only becomes visible in hindsight. Most people look back at it later, shaking their heads, wondering how they missed it. The signs were there. The data was available. The physical market was speaking clearly, but the noise of the moment, the psychological anchoring, the comfort of waiting, drowned out everything that mattered. That moment for silver may be right now. And the investors who understand what is unfolding beneath the surface of this quiet, this strange, this deeply unusual period of underspot pricing and absent buyers are not sitting still. They are making decisions, carefully, deliberately, without drawing attention to themselves. This is what serious money looks like when it moves. To understand the strategic implication of this moment, one must first reframe what the underspot pricing environment is actually communicating. Most observers look at silver selling below spot and conclude weakness. They see the discounts. They see the empty dealer floors. They see the absence of retail excitement, and they interpret it as a signal to stay away, to wait, to revisit the market when things feel safer, when the energy returns, when the price confirms what they already want to believe. But serious investors read that same data and arrive at a completely different conclusion. Underspot pricing does not signal that silver is losing value. It signals that the current holders of physical silver need liquidity faster than the market is providing it. It signals a temporary misalignment between supply in dealers' hands and the psychological readiness of retail buyers. It signals, for those with capital positioned and patience developed, one of the rarest conditions a physical asset market can produce: a price below reality. And in the entire history of financial markets, assets priced below their fundamental reality have never stayed there permanently. The role of COMEX in this environment cannot be overlooked by any analyst attempting to construct a complete picture of where silver is heading. COMEX is the engine of paper silver pricing. It is where futures contracts are written, where positions are built, where the number that appears on every investor's screen is ultimately derived. And for decades, the relationship between COMEX paper pricing and physical market reality operated within an acceptable range of tension. That tension is no longer acceptable. The gap between what COMEX says silver is worth and what physical buyers in the real market are willing to pay is widening in ways that historically precede significant price events. Delivery notices at COMEX, the documented requests by contract holders to take actual physical metal rather than cash settlement, have been accumulating. Vault inventory reports, the documents that record how much real silver sits in registered and eligible categories within COMEX warehouses, are showing movements that sophisticated observers track with serious attention. When paper and physical diverge, one of them is wrong. Paper markets have enormous power to maintain a narrative, but they have never, in the full sweep of financial history, successfully maintained a narrative that physical reality directly contradicted, not indefinitely, not without consequence. For those holding alloy silver in this environment, the strategic calculus requires honest assessment. Alloy silver, sterling, 90%, 80%, 40%, carries a unique risk profile in the current market that pure bullion does not. Its premium compression has been severe. Its liquidity has deteriorated. And in an environment where dealer floors cannot move it even at $5 below spot, the holder of significant alloy positions must ask a question that is uncomfortable but necessary. If dealers cannot sell it today, what changes tomorrow? The answer is not that alloy silver becomes worthless. History does not support that conclusion, but it does suggest that the recovery of alloy premiums will lag behind pure bullion recovery in the next demand wave. When retail buyers return, and the behavioral economics established in previous analysis confirm they will return, they will reach first for eagles, for rounds, for recognizable, guaranteed, easily liquidated forms of pure silver. Alloy will move second. For the strategic investor, that sequencing matters enormously. The coming catalyst is not a mystery to those who study market cycles with discipline and patience. It will not announce itself with a press release. It will not appear first on financial news channels or in the morning briefings of retail investment platforms. It will appear first, as it always does, in the physical market, in a sudden tightening of dealer inventory, in premiums that begin climbing faster than spot price, in the quiet phone calls between serious buyers and trusted dealers that happen before the public ever notices anything has changed. Several conditions are converging that historically precede this kind of catalyst moment. Retail capital is sitting on the sidelines, not absent, but waiting. Institutional positioning in physical delivery is quietly accelerating. The paper-to-physical disconnect is widening beyond historically stable parameters. And dealer inventory, currently bloated with discounted alloy silver that nobody is buying, represents compressed demand energy that does not dissipate. It accumulates. And accumulated demand, in a market with genuine physical supply constraints, does not release gradually. It releases all at once. The serious investor watching this market today is not asking whether silver will move. That question has already been answered by decades of monetary history, supply dynamics, and the irreversible trajectory of a sovereign debt expansion across the world's largest economies. The serious investor is asking three precise questions. First, in what form should silver be held when the next demand wave arrives? The answer that the current market is providing, clearly and without ambiguity, is pure bullion over alloy, recognizable over obscure, liquid over discounted. Second, at what threshold does the psychological dam break and retail capital flood back into the market? The behavioral data points consistently toward one number, $100. When silver crosses and holds above that level, the sideline buyer does not cautiously re-enter. They rush. Third, and most importantly for the strategic mind, how much time remains before the conditions that currently allow for patient, deliberate accumulation disappear entirely? Because the window that exists today, the underspot pricing, the absent retail competition, the discounted physical market operating in the shadow of an elevated paper price, is not a permanent feature of this cycle. It is a temporary condition. And temporary conditions, in financial markets, have a way of ending faster than anyone expects. The silence from buyers today is not the sound of a market dying. It is the sound of pressure building. It is the held breath before the exhale. It is the stillness that serious investors throughout history have learned to recognize, not as a reason to wait, but as the last quiet moment before everything changes,